Imagine a heavy car coasting slowly down a hill, and then picture that same car accelerating aggressively up a steep, mountainous incline. If you only measure the speed of the vehicle, you miss the massive mechanical effort required to fight gravity. When we look at financial markets, the price of an asset is simply the direction the vehicle is traveling. Volume is the engine. It measures the raw effort and conviction required to push the price in that direction. Mechanically, volume is the exact number of individual transactions executed during a specific time period. The baseline rule for reading it is straightforward. Tall volume bars indicate high market participation, while short bars indicate low interest. Tracking price movements without checking the corresponding volume is an incomplete strategy. It hides whether a move is backed by real capital or if it is coasting on empty momentum. Mastering volume allows a trader to interpret the actual supply and demand mechanics behind every price fluctuation. A technical breakout occurs when price successfully pushes past a historically established resistance or support level. The most common hazard retail traders face during these events is the fake-out, a trap where price briefly breaches a key level to trigger buy orders, but immediately collapses and reverses direction. A breakout operates like a heavy, braced door. One person pushing is repelled, but 10 people hitting it simultaneously will shatter it open. This chart shows how a successful breakout structures itself. Notice the overhead barrier repelling price until a green candle pushes straight through. To prove the move is genuine, check the lower pane. At the exact moment of the breakout, we see a massive volume spike. That spike confirms heavy market participation. It requires significant institutional capital to generate that much transactional density, proving the breakout has real structural conviction. Conversely, if price breaks resistance on low volume, the lack of participation exposes the trap. Very few traders are involved, meaning the move has no weight behind it and will likely fail. Volume is a lie detector. A structural break without a surge in participation is an illusion of strength. While explosive volume validates the beginning of a trend, analyzing how that volume behaves over time reveals when the trend is starting to die. We identify this decay using volume divergence. This is the specific mathematical scenario where price and volume start moving in opposite directions. This chart diagrams a healthy market environment. Both the price trajectory and the participation level are rising together in total agreement. But look at the weakening phase on the right. The price line continues to climb to new highs, while the volume line sharply declines. This bar chart shows exactly how that divergence appears on a standard trading screen. As the price pushes higher, the corresponding volume bars systematically shrink. The mechanics are straightforward. The trend is continuing purely on residual inertia. Fewer and fewer buyers are actually stepping in to support the new price level. Returning to the car analogy, if the number of people pushing a vehicle uphill drops from 10 to 2, the car may still roll upward for a brief moment, but gravity ensures a stall is inevitable. Divergence exposes a market running completely on fumes. It gives you the mathematical warning of a reversal well before the actual price action breaks down. Not all trends die a slow death from divergence. Some terminate violently in a sudden, extreme rush of activity. A volume climax is an extreme, anomalous spike in trading that occurs near the absolute peak of a massive market move. This chart isolates the price structure of a buying climax. Notice the steep parabolic move at the final peak of the rally. Directly underneath that parabolic move, the volume data confirms the climax. A massive, towering spike accompanies the final price push. This configuration represents total exhaustion. Every remaining buyer rushes into the market simultaneously, absorbing the remaining supply, but leaving zero future liquidity to sustain the uptrend. It operates like a panicked crowd seated surging toward a single stadium exit. The massive rush creates a bottleneck, bringing forward movement to a dead halt. The inverse setup is the selling climax. Here, absolute panic selling flushes out the market entirely, eliminating all downside pressure and creating a permanent floor for a bounce. While high volume validates the start of a healthy trend, an extreme, climactic anomaly almost always marks its absolute end. If we scale out from individual charts, these specific volume signatures map the entire macro life cycle of the market. Large institutions, hedge funds, and banks, collectively known as smart money, possess the heavy capital required to dictate macro market direction. They operate like a professional poker player seated with novices. They build an advantage quietly and aggressively extract capital when the odds are locked in. The Richard Wyckoff model illustrates how institutions engineer market phases. First is accumulation, where smart money quietly buys suppressed assets, building positions without triggering a price surge. Once complete, we enter mark-up. Price breaks upward, catching the attention of retail traders. We can track this mechanically. Looking at the accumulation zone at the market bottom, distinct volume spikes reveal heavy institutional buying during events like a selling climax. At the peak, distribution begins. Smart money sells accumulated positions at higher prices, passing risk to late-arriving retail buyers. With distribution finished and institutional support withdrawn, the market enters the markdown phase, resulting in a sharp, unhindered collapse. This chart synthesizes the entire sequence. The isolated volume surges at critical structural lows and breakouts are the exact mathematical footprints of large players executing their entries. Institutional strategy is invisible if you only look at the price line. Volume strips away the noise and reveals the actual cyclical playbook. By combining these observations, we establish a robust volumetric framework. We check for heavy volume to validate structural breakouts and filter out retail fakeouts. We monitor for volume divergence as an early warning system against momentum decay. We recognize that a volume climax signals extreme market exhaustion and an imminent reversal. And we use the Wyckoff cycle as the master map to connect all three of these events into a single cohesive institutional strategy. It all reduces to the mechanical measurement of effort versus result. Price merely tells you what the market is doing right now. Volume tells you exactly why it is happening.